I'm sure you already know that investing in weekly dividend ETFs is the best way to plan your retirement and get better control of your money. And today, we're breaking down 5 of the safest ETFs that do exactly that, from rock-solid government funds to clever income strategies that don't take crazy risks. So make sure to watch all of these to decide how you want your ideal portfolio to look like depending on your needs. All the data here is verified straight from official fund documents and updated for fall 2025. No hype, just facts. So grab a coffee and let's dive into these weekly income powerhouses, starting with the safest one on the list. ETF number 1, Round Hill Weekly T-Bill ETF. Ticker WEEK. If you could get paid every single week and still sleep easy knowing your money's backed by the US government, this ETF is for you. This thing right here is about as safe as it gets in the investing world. As of 2025, it's trading right around $100 a share, managing roughly $105 million in assets, and it charges a very modest 0.19% expense ratio. The yield? Around 1.7% annualized. Not massive, but incredibly steady. Here's how it works. WEEK invests entirely in short-term U.S. Treasury bills, typically those that mature within 1 to 3 months. And instead of holding them all to maturity and sitting idle, the fund uses what's called a rolling ladder strategy. That just means, as one T-bill matures, it immediately reinvests into a new one. The result? A smooth, predictable flow of income that hits your account every single week. And the beauty here is in the safety. You're basically earning interest from the safest asset class on earth, fully backed by the US government. So, while it's not going to make you rich overnight, it's perfect for those times when you want your money working, but not risking. This makes WEEK an ideal pick for ultra-conservative investors, retirees, or really anyone who's just parking cash between bigger moves. It's steady, it's transparent, and it delivers exactly what it promises: weekly income without the stress. Now, if you're looking for a little more yield while still keeping that safety net intact, the next ETF steps things up a notch. ETF number 2, Texas Capital Government Money Market ETF, ticker MMKT. Think of this one as WEEK's slightly bolder cousin, still playing it safe, but with a noticeably better paycheck. This market ETF is currently trading around $100 a share, with about $58 million in assets under management. The expense ratio sits at a very reasonable 0.2%. And here's the eye-opener. The 30-day SEC yield is hovering around 3.9%. Now, the way MMKT works is actually pretty simple. Imagine a money market fund, but wrapped in an ETF shell for easier access and weekly distributions. It invests at least 99.5% of its assets in U.S. government securities and cash equivalents, all while staying fully compliant with SEC Rule 2(a)(7). What that means is, it keeps all of its holdings with very short maturities, usually under 60 days, to maintain stability and liquidity. So your money's not tied up, and the fund can easily adjust as interest rates move. And here's the best part. You're earning close to 4% annualized yield with weekly payouts, all from assets that are still government-backed. It's like having a medium-yield stable savings account that actually pays you every week instead of once in a while. This makes MMKT a great fit for conservative investors who want a higher yield than what they'd get sitting in cash, but who still want the peace of mind and easy access to their funds. Okay, so far we've covered the ultra-safe options. But what if you want something that taps into the power of big-name stocks while still getting paid weekly? Well, the next ETF is all about that. By the way, if you're enjoying this video so far, hit that like button. It really helps out the channel. And don't forget to subscribe for more videos just like this. I make easy-to-understand breakdowns on ETFs and income strategies so you can build a stress-free, confident retirement. With that said, let's get to the next one. ETF number 3, Round Hill BRKB Weekly Pay ETF, ticker BRKW. Now we're entering the creative zone, where weekly income meets the legendary Berkshire Hathaway. As of 2025, Round Hill BRKB is trading around $47 a share, managing roughly $4.2 million in assets, with an expense ratio of 0.99%. It's definitely a bit pricier on the fee side, but here's why some investors don't mind paying that. The fund's distribution yield sits around 3%, and you're collecting it every single week. So, what exactly does it hold? Well, this ETF gives you exposure to Berkshire Hathaway Class B shares. It's the same stock run by Warren Buffett himself, but with a bit of a twist. It uses total return swaps to get about 1.2 times exposure to Berkshire's performance, and then it layers on a covered call strategy to generate income from option premiums. Basically, you're getting a Buffett-style portfolio, solid, diversified, and built on fundamentals, but with modest leverage and a built-in income stream. Instead of waiting for long-term capital appreciation like most Berkshire investors, you're pocketing small, steady paychecks every week. Now, there are a few things to keep in mind. BRKW is still pretty new and doesn't have a lot of money invested in it yet, so it doesn't trade as much. That means the price can move up and down more than usual. It's not something to build your whole portfolio around. It's more like a fun way to earn extra income from one of the most trusted companies in the world. So, if you admire Berkshire's long-term stability, but want a way to turn that admiration into weekly cash flow, BRKW might just scratch that itch. All right, now let's ramp up the income side a bit. The next two ETFs are for investors chasing higher yield with just a bit more risk baked in. ETF number 4, Yield Max S&P 500, 0DTE Covered Call ETF, ticker SDTY. All right, this one's for the income hunters, the people who see a big yield number and say, okay, now you've got my attention. Because this ETF is paying nearly 24% annualized, and yes, those payments come every single week. This ETF, as of 2025, is trading around $45 a share, with about $13 million in assets and an expense ratio of 0.99%. The distribution rate, a jaw-dropping 23.7%, mostly coming from option premiums rather than traditional dividends. So, how does it actually generate that kind of yield? SDTY makes money using a daily trading strategy. Each morning, it sells short-term contracts, called options, on the S&P 500, basically bets that the market won't go too high that day. These contracts expire the same day, which is why it's called a 0DTE, which means 0 days to expiration strategy. When those contracts expire, SDTY keeps the small fees. These are called option premiums. It earned from selling them. It does this every day, collecting those small profits throughout the week, and then pays them out to investors at the end of the week. Now, before you start thinking this is free money, here's the key detail. About half of what you get paid is an actual profit. It's your own money being given back to you. That's called return of capital. It's not really a bad thing, but it's important to understand what's really fueling those yields. The trade-off here is that while the income looks incredible on paper, the strategy is complex and trades daily. If the market suddenly moves up or down, especially when things get more volatile, performance can take a hit. So, it's not the kind of ETF you set and forget. That said, for investors who understand options or want to add a high-yield, high-frequency income stream to their portfolio, SDTY can be a fascinating tool. It's an aggressive play, but when used wisely, it can complement more stable holdings like WEEK or MMKT. And finally, if you want something that's tied to gold and comes with even higher income potential, the last ETF on our list might just take the crown. ETF number 5, Defiance Gold Enhanced Options, Income ETF, ticker GLDY. All right, this one's really great. We're talking about the highest paying ETF on the entire list. It's tied to gold, and it's cranking out a staggering over 40% annualized yield paid every single week. And as of 2025, it's trading around $17 a share, managing roughly $4.8 million in assets, and it carries the standard 0.99% expense ratio, like most of the income-focused ETFs we've talked about. But what really stands out is the distribution rate, around 41.7%. So how does it do that? GLDY makes money by selling put options on the big gold ETF called GLD. That's the fund that follows the price of gold. While doing this, it keeps cash and short-term treasury bills on the side as backup. If gold prices stay strong, GLDY just keeps earning small option fees every week. But if gold prices fall too much, the fund might have to buy gold itself, which isn't really bad because owning gold can help protect against inflation and add some diversity to your portfolio. Now, here's the big caveat, and it's an important one. Roughly 93% of GLDY's distributions come from return of capital. So once again, a large portion of that income isn't pure profit. It's part of your own principal being returned to you. That doesn't make it bad. It just means you need to view it as a cash flow tool, not a guaranteed yield generator. This ETF is best suited for investors chasing high income who also have a tolerance for short-term volatility and understand how options-based strategies work. It's high risk, high reward, but undeniably creative. From T-bills to Buffett to gold, these 5 ETFs prove weekly income investing can fit any style, safe or high yield. There's a strategy for almost every investor. All right, let's quickly recap the lineup by safety tier. At the ultra-safe end, we've got WEEK and MMKT, both backed by U.S. government securities, perfect for steady, low-risk income. In the moderate risk zone, there's BRKW, giving you exposure to Berkshire Hathaway with a creative weekly income twist. And for the high-yield, more speculative side, we've got SDTY and GLDY, both using options-based strategies to deliver those eye-popping payouts, but with a bit more volatility baked in. Now remember, weekly dividends aren't a get-rich-quick play. They're about turning your portfolio into a consistent cash flow engine, where your money's always working and rewarding you on a regular basis. Okay, weekly income sounds great. But how does this actually fit into a full retirement plan? I've got you covered. Check out my video on the perfect retirement portfolio. I break down how to balance safety, growth, and income so your money keeps working long after you stop.